All right, we're live. So, probably last video of the day here, and we're talking about the S&P. S&P is just making new daily highs. I like selling it right here. Now, as I said last night, I wasn't wild about the idea of selling the 50-hour moving average, and now you can kind of see why. It used it as a resistance point and then a springboard. Okay, and we're now in that spring. So why am I changing my tunes here? Well, first of all, I am bearish. I am a seller. I'm looking for a place to sell. Okay. It looks about as bullish as you can get. This is where I'm questioning my hypothesis. It's exactly where I want to have the discipline to sell. Okay. Now, there is one sort of there's two higher points that I could have waited for. 46, which is where the 200-day or 200 hour and the 800-hour moving averages converge, and then 46.70, which is that point of resistance and support that we all know and love so much. But I decided, you know what, I'm going to pull the trigger. Sometimes the perfect is the enemy of the good, and I'm ready to get short. Now, I'm going to go through why it is that I additional bearish factors, why it is that I'm bearish. Well, actually, I'm not going to go through the basic. You can watch my other videos. I'm not going to repeat the basic thesis, but I'm going to say price is at an interesting juncture and that there are a couple new bearish factors to watch. One is that the market leaders are lagging. So I'm talking about Apple, I'm talking about Google, Tesla, obviously, Microsoft, and Amazon. They're all lagging relative to the performance in the S&P. I've got a video on that, and there is a link in the show notes if you want to watch that. The other is European power prices. This is starting to look like an economic event, meaning this is starting to have the magnitude to where it's actually going to create a drag on GDP. And I have a link to that video in my comments. But real quickly on the European power price comment, I don't think it's on anyone's radar. But fundamentally, what do companies, which underlie the markets, but we'll say markets, what do markets dislike? There's two main things they dislike. A lack of profitability, that's the obvious one. And what's the other one? Uncertainty, okay? Surging power prices, or what we would call like traditionally an oil price shock. In this case, it's an electricity price shock, an energy price shock. Let's just call it that, okay? An energy price shock has both. Creates uncertainty, and it creates a less profitability, lack of profitability or less profitability. So I think that's a big bearish factor. Big bearish factor. All right, two reasons I like this entry point. Number one, cost of protection is low. What I mean by that is the implied vols. Implied volatility is low. We're back down to 21. In spite of the fact of large realized moves. Okay, large realized moves means we're going up, we're going down, we're going up in these big waves. So we've got large realized vol compared to implied vol. Implied vol is at 21. I'll add this. Implied vol has not made a new low this hour. S&P has made a new high this hour. Okay, so that's another thing that I find in a very, very short-term bullish. The markets are thin. We're going into a holiday week, and they're relatively unprotected. Okay, so there's not a lot of downside protection in this market. And as I already mentioned, prices have now gotten to a point where I and everybody else is questioning the bear hypothesis. Everybody's on the bull bandwagon. Everybody's saying, hey, it looks pretty darn bullish. Hey, we're going to have the Santa Claus rally after all. Hey, shorts are going to get their faces ripped off. Let me just pull up a couple of the flow articles here. Let's see. Goldman, the collapse of the Build Back Better, loss of 1.75 trillion in fiscal stimulus means Fed will have to ease monetary stimulus tightening. Expect Fed speakers to address this in the coming days. And from Goldman Sachs, the spread of the Omicron variant may make Fed officials more reluctant to raise interest rates. Expect this to be the dominant narrative by Wednesday. That's tomorrow. So that's from Goldman Sachs. Nomura, warns of, quote, potential squeeze melt up into new year amid deteriorating liquidity. That's the old Santa Claus rally, ripping the face off of the shorts. So all of a sudden, all of the news flow is bullish. And why not? Look at this chart. It looks amazing, right? We've got all this passive money coming in to buy. So this is ironically the other reason that I like this entry, because I personally have gotten to the point where I'm like, why would I be a bear? Looks pretty darn bullish. Bullish, yeah. Okay, so finally, two ways this trade could fail. We are over 4,600, so that means Gamma has flipped. Gamma has flipped means that all else equal, volatility will be suppressed. Okay, and then secondly, this argument that all of the Wall Street desks are making, that there's all this passive money and it's going to lead to a Santa Claus rally and it's going to rip my face off. Could happen. Okay, so those are the two ways that this trade could fail. But I am trying to mimic past successes, and past successes say one of the clear ways of successful entries is if there's a clear new direction in the market, which would be this, a bearish fall of 220 points from all-time highs to below the 50-day moving average. Okay, when there's a bearish wave or a new wave in the market, within that powerful trend indication, it then requires the patience to absolutely wait for things to look kind of doubtful in the other direction. So we would not want to go short here, or even necessarily here, okay? We want to wait until things are like, why would you sell this, okay? So yeah, just when you might be starting to question yourself, that's the place to enter. Okay, so that's where we're at right now. We'll see how it works out. Truth be told, I got in at 46.22, so we're up 10 points from my entry. And so far, it's been doing very badly. And you see this looks like passive money just going like boom, 7,000 shares, boom, 7,000 shares, not shares, but lots of the S&P index. So right now, definitely the Santa Claus passive money thesis is playing out. We'll see how it looks by the end of the day. Cheers.